Super Microcomputer, SMCI, the server builder that suddenly looks like the friend who promises to bring the snacks to every party, has had a turbulent month. The shares have plunged almost 29% in the last month as investors reevaluate whether Supermicro is a core AI infrastructure play or a high-speed roller coaster with some loose bolts. What actually happened? The short version. Two big things hit SMCI back-to-back: earnings disappointment. Q4 FY 2025 revenue and EPS came in below street expectations, and the numbers highlighted ongoing margin pressure. The company's Q4/fiscal 2025 release and call showed revenue and profit metrics that didn't quite match what investors had been pricing in. A 10-K/control shock. In the company's 10-K/annual filing, the firm disclosed material weaknesses in its internal control over financial reporting, ITGC gaps, segregation of duties issues, etc. That raised fresh corporate governance concerns and spooked investors. A classic, not the number you want to see on page 1. Together those two headlines turned an investor love affair into a cautious breakup text. The numbers that matter, keeping it simple. Stock move, 29% over the last month, big, fast, and painful for anyone who bought near the highs. Forward PE, SMCI 16, cheap by headline PE standards. Forward PE, NVDA, 38-39, much pricier. The comparison is what a lot of headlines lean on. Is Supermicro the cheaper way to play AI? Numbers tell a story. SMCI looks materially cheaper than Nvidia on a forward earnings multiple, but that cheaper label doesn't automatically mean safer. Why earnings plus controls matter? An analogy. Imagine you run a pizza shop that's famous because you make the world's crispiest crusts. Nvidia equals the crust tech. SMCI builds the ovens that let restaurants bake the crusts at scale. Investors love the idea: if crusts are in demand, sell more ovens. Now imagine two problems appear at once. You tell customers you sold a ton of ovens last month, but when the accountant checks, margins on the ovens are shrinking, maybe because steel got expensive, or you had to offer big discounts. That's the earnings/margin pressure problem. Then your bookkeeper tells you that the till and the inventory logs don't match, and the locks on the storeroom are sometimes open. That's the internal controls problem. A cheaper valuation, lower PE, is like a sale sign on the pizza shop. It's attractive, unless the ovens are burning fuel faster than before and the storeroom is unlocked. Suddenly the bargain could be a fire hazard. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Why margins have been pressured, plain language. The Q4 results exposed persistent margin pressures. There are a few ways that can happen in an AI server business: higher component costs, memory, PCBs, interconnects. Mix shift toward lower margin products or custom builds for certain customers. Pricing pressure as customers, even big hyperscalers, push for lower per unit prices, or SMCI gives concessions to win large GPU orders. The result: revenue can still grow, you can ship more ovens, while margin percent collapses, each oven earns less, which squeezes profitability and investor enthusiasm. The Q4 release made those pressures visible. The governance wrinkle: why material weaknesses matter in real life. When a company says there are material weaknesses in internal control over financial reporting, it's not just a boring auditor phrase. Practically, it means management and auditors found gaps that could cause material misstatements in financial statements if not fixed. Investors worry about accuracy, transparency, and whether management is on top of the business. It invites regulators, invites skepticism from large institutional buyers, and can complicate fundraising or deals. Supermicro's 10-K lists specific items: IT general controls, segregation of duties, etc., the kind of list that makes value investors mutter governance risk. So, cheaper than Nvidia, but why not just buy SMCI for the discount? A forward P/E of 16 for SMCI versus 38 for Nvidia is headline-grabbing. Cheap multiples are tempting, who doesn't like a sale? But price is only part of the story. Think of it this way, Nvidia, NVDA, is the GPU architect and ecosystem king. Its margins come from design, IP, and pricing power. That's why investors accept a high multiple. They're paying for durable margins and growth expectations. SMCI operates in a hardware assembly and systems market, more cyclical, tighter margins, and more operational execution risk. Also, governance issues add a discount risk premium. Investors demand lower multiples to compensate for higher uncertainty. Buying SMCI because it's cheaper is like buying last season designer sneakers because they're 60% off, fine if they're in perfect condition and you know the brand. Not great if the zipper is broken and you might need to return them to a brand with a shaky warranty. The bright spots, what makes SMCI still interesting. It's not all doom and gloom. SMCI retains several genuine qualitative reasons investors might want exposure. Critical role in the AI supply chain. SMCI is a recognized supplier of server platforms optimized for the latest GPUs. That means it benefits from continued GPU demand as data centers scale up. If the AI market keeps hiring servers, SMCI is in the addressable market. Revenue scale and growth runway. Even with margin pressures, revenue growth, and big multi-year contracts, can underpin long-term returns if margins recover. Lower multiple equals optionality. A lower forward P/E creates upside potential if management fixes controls, margins stabilize, and growth resumes. Investors who believe remediation and execution are possible can see asymmetric reward relative to current price. Customer stickiness. Data center operators don't constantly swap server vendors mid-deployment. There can be contract inertia and integration costs that help incumbent vendors. That can provide some insulation when industry cycles wobble. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this, I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.